Hello and welcome to Morning Trade with Moneycontrol. I'm Karunya Rao and I'm here to help you navigate the trading day with actionable strategies, sectoral trends and most importantly, your queries during the show. So please keep sending us your comments and questions. We'll have them addressed towards the latter part of the show. But before we kickstart, let's see what the global handover looks like. Positive session on Wall Street. The S&P 500 snapped a 5-day losing streak, its longest since October, while the Nasdaq gains over 1% ahead of the release of Purchases Price Index data for the month of November. Stocks in the Asia Pacific opened largely higher, while the SGX Nifty is signaling a positive start for the Indian market. European markets also ended marginally lower yesterday as investors' nervousness continued over the state of global economy and inflation. On the show today, we take a closer look at the technicals of Paytm, Shalby and Sun Pharma. We also discuss how debt fund investors should play the RBI rate hike. Okay, let's get going and talk about what's trending, and that is the RBI rate hike this week, which could impact investors across the board and across different asset classes. Joining me in conversation is my first guest, Ashish Shah from Wealth First. Hi, Ashish. Thank you so much for chatting with us this morning. Talk to us about how the rate hike regime stands to impact mutual fund investors, especially those who have exposure to debt funds.
Good morning to all and the viewers. See, this RBI rate hike is expected in line. There is no surprises. And I think that is a good thing Mr. Das is doing since last couple of quarters. And for mutual fund investors, the specific question, I believe, if you are short-term investor less than 3 years, then the short-term funds will give you a much better return than the bank fixed deposit or something like that. But if you are, I think, 3 year and above investor into mutual debt market, it's a Goldilocks type of a scenario because your target maturity funds, which are giving you around 7, expected to give you around 7 plus because of the higher inflation, 5% around indexation, as well as a long-term gain tax benefit. So we advise clients for a short-term funds, and if you go for 3 years and above horizon, if you have that allocation, then go for target maturity funds around 4 to 7 years of horizons. Depends on your requirement and cash flow requirement.
Okay, but if we look at the prospects for a short-term fund vis-a-vis long-duration fund, which one is preferred right now? I think going by what you said, short-term looks more attractive, but can you also tell us why that is?
See, I think there is going to be a lot of demand supply also matters rates in the market. You can see a lot of fixed deposits of AAA highest rated companies are borrowing around 7.80% annualized. I think that is something, as far experience speaks, we are heading for a little bit of higher interest rates in coming 2 quarters. That's why we get the benefit to be in a short-term funds to get, if your horizon less than 3 years. Because I think we should get around 8 plus short-term rates in the market in a AAA and above, at least for 6 to 9 months to 12 months. That is my view. That's why I suggest short-term funds for a short-term horizon. Okay. Now, if you want to play the long, which you asked me, you want to, the interest rates are picked out. That's why I play interest rate curve, or I will play a long horizon. I think this is not the time. We should wait for February, particularly this budget, then February, and Fed 2 meetings. Then I will advise the client to go for a 15-year bond fund or a 15-year of government security to play the yield curve. Today, short term is I think is a best sweet spot, and 3 years above. A 4 year or 5 year of target maturity fund is the best place.
Okay, all right. But what about the expectation of the peaking of a rate hike cycle? How far away are we from that point? And as and when we get more visibility, would it be good to enter into long duration funds, including gilt funds, perhaps?
I see gilt fund. I think I like gilt fund. The problem in gilt fund, one is the art of exiting. Because suppose you enter after 50 basis point rate hike, suppose happen at terminal rate happens 675 or 650. You buy a 15 to 20 years of the gilt or gilt fund, which is higher duration. But after 1 or 2 years, you will get a rate down. then you get a premium, you get extraordinary return. But to get out of the gilt fund is an art. It is not science. And that is a place where most of the investors stay there and they lose money. I think this is my experience, which I am sharing with you. And third thing, in a HNI investor, the taxation is a big issue. Less than 3 years, you remove your money from a debt fund, it adds to your marginal tax rate. That's why post-tax return, if you want to consider, then gilt fund, I think this is the trade-off you have to take off between taxation, post-tax returns, and the net gross rate.
Okay. All right, Ashish. Thank you so much for joining in and sharing your views with us as far as the debt investors and their strategy is concerned, especially amid the rate hike cycle that we're in. Thank you so much once again. Okay, let's shift gears and talk about what's happening in the markets and how the market is likely to play out today.